Why do we have a lot of money flowing around the world? Now, this is like billions of dollars flowing around the world, but you still have a lot of businesses in many parts of Africa, promising businesses, promising startups that are still struggling to raise money. How come we have a lot of money but a lot of lack at the same time? So that's the irony, that's the paradox I want to talk about in today's lesson. I want to help you change the situation to make you see ways to access many of the opportunities you may be missing out on. Every big thing starts small. It's a natural law. Every big multinational corporation was once a small business. Welcome to the Small Starter Business Podcast, a unique podcast for practical tips and advice to help you start, grow, or turn around your business. This is another episode of the Small Starter Business Podcast. I am your host, John Paul Iwuoha. Today we have a very interesting topic on our hands, and it's about how to prepare your business for investment and attract investors. This is one of the common pain points that entrepreneurs have. You have a good idea, you have a good business that has potential, but you just don't have enough capital to take it to the next level. You don't have the capital to start that business, to transform your idea into a real business. You're looking for capital to grow that small business because you're having trouble serving your customers. It's showing signs of big potential, but you just cannot find the capital to make that happen. Or you have a business that has been, maybe it's a family business that's just been turned on to you, or it's a business that's run for quite some time and has run into trouble. So the business is stagnant, it's not performing like it used to, and you need to turn around that business. But you need capital, you need funding to turn it around. So how do you prepare your business for investment so that you significantly increase your chances of raising funds from potential investors? And that's exactly the issue I'm going to thrash with this episode. So the very first thing to look at is, why do we have a lot of money flowing around the world? Now, this is like billions of dollars flowing around the world, but you still have a lot of businesses in many parts of Africa, promising businesses, promising startups that are still struggling to raise money. How come we have a lot of money but a lot of lack at the same time? So that's the irony, that's the paradox I want to talk about in today's lesson. I want to help you change the situation to make you see ways to access many of the opportunities you may be missing out on. But I think the first and most important place to start will be to look at the three big reasons why many African entrepreneurs can't raise funding. Now, the first reason is lack of awareness. A lot from my interaction with entrepreneurs on a daily basis, a lot of us do not know, are not aware of the opportunities, of the amazing funding opportunities that are available in the world today. And this is ironical because we live in the age of the internet. So information is like one click away. But the internet also comes with its own burden. Because we have so much information, it's now difficult to sift through that information. It's overwhelming information. And on top of that, we have fake news and fake information to deal with. So there's a lot of awareness on where to get information about funding, what funding opportunities are available, and how to access them. The second big reason why many entrepreneurs have issues attracting funding is lack of skill. Now, fundraising is a skill. You don't just knock on doors and people give you money. So fundraising requires a lot of skill. You need to be communication skills, business skills, negotiation skills, presentation skills, persuasion skills, financial skills. You need to be able to talk numbers. You need to speak the language that investors understand. So there are a lot of skills that come into this, and many of our people are lacking in it. But the good thing about the lack of skill is it can be fixed. Lack of awareness can be fixed. Lack of skill can be fixed. You can learn the skills you need to move from a complete novice to somebody who can confidently stand before investors in a room of investors and pitch their business and have people walk forward with checks. The third big reason is the lack of preparation. So there are even people who have the skill. There are people who are aware of the opportunities, but they are sorely unprepared. And The reason why preparation is important is raising capital is not a sprint. It's not something you start today and maybe you get the money by weekend. It's possible, but it's improbable. Now, it's a marathon and you need to be prepared for it. There are several different aspects that we're going to look at in this, I'm going to talk about in this episode. And lack of preparedness hurts us because you cannot start preparing for your opportunity when it comes. You need to prepare for opportunity in advance so that the moment you come across an investor who is interested in investing in your business, you have everything set. Your business is investment ready. So in this episode, I'm going to focus on investment readiness. How can you get your business investment ready so that you have a higher chance, a better chance of attracting and convincing investors to give you the money you need to start, grow, or turn around that business? So when it comes to preparing your business for investment, there are 5 very important things you need to do to prepare your business for investment. And I'll start with the first one. The first one is understanding the basics. Now, this is a big problem because if somebody is trying to raise money and the person says, I want to raise capital, but the investor is asking you, what kind of capital do you want to raise? And many of these entrepreneurs are shocked. They're like, money is money. I just want money. But to an investor, money is not money. Money can take 3 different forms. That money can be equity, it can be a loan, or it can be a freebie. A freebie could be like a grant, a donation, prize money, an endowment or something. So yes, you need money in your business, but what kind of money do you need? So simple basics like this, understanding the difference between equity and debt and freebies, understanding the limitations of equity, debt, and freebies, understanding the advantages. So even before you raise money, you should be crystal clear about the type of funding, about the type of money you want, and you need to know if it is best for your business. There are businesses that shouldn't be taking equity because you're risking too much. Maybe what you need is a loan or a grant or something to just tip you over into success. There are businesses that are going to crumble if they take loans. So the best thing you need is equity. So you need to be aware of this basis because these are basics that investors would expect that you would know. And before you walk into a room to discuss with investors, you need to have this kind of knowledge. Another common basic is the 4 stages of business. Some businesses just say, I want to raise money. And you ask them, where do you want to raise that money from? You say, I want to raise money from the bank. I've been applying for a loan from the bank, but they're not listening to me. They're not approving my application. And when you look closely, you discover that this business in question has no business asking a bank for money. And that's because there are 4 stages of business. The stage of your business determines the kind of investors you should be talking to. It often determines the kind of money you should be asking for, how much you can ask for, and how seriously they are going to take you. So quickly, I'm going to run through the 4 stages of business. The first is the idea stage. All you have is an idea in your head. You have a bright idea. Maybe you have a business plan or a concept paper or drawings or something. But what you have is an idea, a business that is not yet live. It's just in your head. Now, at that stage, you are very risky. And not every investor will touch you because there is a big difference. There's a big world of difference between a business that only lives in your head and a real life business that has customers, has employees, and is making money. There's a huge difference in the eyes of an investor between an idea and a real business. But many entrepreneurs often do not see the business. They just see it as, I have this idea that is guaranteed to make a lot of money. All I need is the capital to make it happen. That's not true. there are a lot of steps between idea and real business. And the reason you don't know is because you've not started. But investors can see it for what it is. So there's the idea stage. Then there's the startup stage. This is, you have started a business. You are open for business. It's either you have started selling the products or you are producing, you are in production mode. So an example would be an agribusiness that has a plantation that's already planted. So you've not started selling. You will sell in the harvest time, but you've gone live. You are producing the actual products you're going to sell. Also, I would also use an example of somebody who is selling shoes from the boot of his car, or who is running a small business in a corner of her bedroom. That's still a startup. You don't need to have an office, a factory, and all that. As long as you have gone live, that's the red line. As long as you have gone live, as long as you're open for business, either selling to customers or producing what you're going to sell, you're already a startup. And those kind of businesses require a different kind of investor. Most banks at that stage will not really touch you because you are still new, you're still risky. If you notice, banks ask for things like collateral. They want to see activity on your bank account, so at least 3 to 6 months of activity. Now, what the bank is looking for is the bank is looking for cash flows. The bank is looking for businesses that already have money coming in. So they want to see how much cash flows your business is bringing in before they can determine to give you a loan. And even the cash flows in your bank account will determine how much money, the maximum they can give you. But a startup doesn't have cash flows. Maybe you're making a few sales or no sales at all. Now, there are other kinds of investors, and I'm going to talk about them here. Now, when you ask people why they haven't raised money, most of the things you hear are banks, bank this, bank that, banks are just one out of several. By my last reckoning, out of 15 different sources, there are up to 15 major sources of funding, but most people just know about one of them, which is just the banks. And I'm going to touch on a few of that here. So after the startup, you progress into the stage of growth. A growing business has the unique problem of not being able to serve all of its customers. The demand is growing. So the business has exhausted its present capacity and needs to increase its capacity. That means it needs to raise funding to expand its capacity to serve its customers. Many kinds of investors are looking for growing businesses because what it means is this right now, this business is doing $100,000. If we can invest money in them, they can start doing sales of $1 million or even $10 million. That's the math that investors cannot make with an idea business or a startup business. But a growing business has one of the best chances of raising capital. They have far more options. Now, this doesn't mean that if you're a startup, you can't raise money. There are also options in fact, there are classes of investors that are focused on startups. There are classes of investors that are focused on ideas. There are classes of investors that are focused on growth opportunities, growth businesses. And then after the growth, we go into the maturity stage. So you will know a lot of companies in this stage. Companies like Coca-Cola, a lot of established companies are in the maturity stage. So essentially, a mature business has reached its limits in the market. It has an established customer base. It's a big business. It has predictable revenue. So for example, Coca-Cola can confidently tell you how much sales they expect to make next quarter. And that's because they have a backlog of historical performance data to show you that. So a mature business is very stable, unlike a growing business that keeps growing in terms of sales and profits. A mature business pretty much understands the market, knows how much money they can make, and is looking for new avenues to grow the business. So for a mature business to raise money, maybe they want to create a new product or they want to enter a new market and they need capital to do that. So these are the 4 main stages of business: idea, startup, growth, and maturity. Now, the kind of investors who invest in ideas cannot invest in mature businesses. That's not their play. Investors are specialized. They focus on particular stages of business. And if you do not have this information, you are going to be knocking on the wrong doors. You're going to have a lot of rejection because you'll be approaching investors who have no business investing in your kind of business. They'll just ask you a couple of questions. And within maybe 10 seconds, they already know that you're not the kind of business they invest in. But if you know the kind of investors that are going to be interested in your business, that means you're going to be knocking on the right doors. You're going to have less rejections, and you're going to significantly increase the chances of raising money for your business. And this is why after listening to this important episode, I recommend two things. You either get our book, Jackpot, my book, Jackpot, which exhausts the topic of raising capital from the very beginning to the end. At about 370 pages, is one of the most detailed compilations on how African entrepreneurs can raise funding in today's world, the sources of funding, the major challenges, the things you need to look out for, how you need to get prepared, and all that. Another thing you can do is to take our free course. We have almost 3 hours on content on raising capital alone. You can take that course. I'm going to leave the links to the free course and the links and the link to the book at the bottom of this episode. Or you can go to smallstarter.com and find it. On the homepage there, you're going to find the book, and you're also going to find a link to the courses, so you can exhaust it, because this episode will not be enough to go into detail, but I'm hoping I can point you in the right direction so that you can start reaching out for the information that you need. Now, the second thing you need to do to get your business investment ready is to know your risk profile. Now, this is very important. When investors want to invest money, what they are looking for is risk. Investors are in the game of risk and reward. They take a risk by investing in your business and get the rewards by the profits or dividends your business provides, or the profits they will make after they sell your business. Now, but when it comes to risk, I find that entrepreneurs have a very poor understanding of risk. And we need to understand where this is coming from. Entrepreneurs are very optimistic people by nature. When we have an idea, we believe it's going to work. I have never seen an entrepreneur who believes their idea will not work, or their strategy will not work, or their business will not grow. We are optimistic, and sometimes to a fault, or sometimes to a blinding fault. Now, sometimes investors are the opposite of us. Investors are optimistic, but it's tempered by realism. Investors tend to be realistic. They tend to see the opportunities for what they really are. So, when an investor looks at your business opportunity, there are 7 critical types of risk they are looking out for. The first is market risk. Is there an opportunity for this? Will this product find customers? Can this business exist in this market? The second is competition risk. Is there a bigger, better company that can crush you when you come into the market? Now, note, entrepreneurs always underestimate the competition. We always think we are better, and we have some kind of secret that the competition doesn't have, and we're somehow going to escape undetected. Investors see right through that. Investors do not underestimate the competition. They don't want to give you money. They don't want to give you $50,000 or $1 million only to have you squashed by the competition. Another critical risk is execution or operation risk. Yes, your idea sounds great. Yes, your strategy for turning around your business sounds great. But do you have the executional capability? Are there operational bottlenecks that will make this impossible? Are you limited by access to distributors, suppliers, raw materials, or important things you need to make this business work? So essentially, the investor is asking, is there something that could make this business not work, or this strategy not work? The other is financial risk. Are you exposed to interest rate risk? Are you in a country where there's foreign exchange risk? So if you're talking to foreign investors, they're going to be looking at, oh, if I give you dollars and you're doing business in your local currency, when it's time to get my returns, is it likely that the foreign exchange risk in your country would have devalued the currency such that I don't get real value for my money? Another critical risk is legal and regulatory risk. Does your business require a permit, a special permission or quota from the government? Is it likely that you're going to be infringing on somebody's trademark, somebody's copyright, somebody's patent? Legal risk can blow you out of the water, because if you get sued by somebody, or if the government does not issue that license, what that means is that the business cannot take off. There's also people risk as a critical risk. What makes you the right person to start this business? Do you have the skills, the knowledge, the capability, the experience, the expertise? Do you have a team? Do you have a team of people with complementary skills? You're trying to start a software company. Do you have any coding skills or computer programming skills or stuff like that? Or do you have a business partner or a key employee who has stuff like that? These are the questions investors ask, because they help them identify critical risks in your business. And another risk is systemic risk. So these are the risks in your business environment. How stable is your business environment? politically, economically, socially, and legally. So without understanding your risk profile, you will be approaching investors who cannot invest in you because unknown to you, your risk is too high for them. Now, investors by nature will take a risk, but investors don't take blind risk. They take measured risk. So if they get the sense that there is too much risk in your environment, or they cannot identify or they cannot measure the risks, they are not going to invest. So investors are not gamblers. That's the difference between investors and gamblers. Gamblers take blind risks. They just take the risk and hope for the best. Investors don't do that. Investors measure the risk, understand the risk before they take the risk. That's the difference between an investor and a gambler. Now, we're coming to the third important thing you need to do to increase your chances of investment. So far, just to recap, the first is understanding the basics. The second is knowing your risk profile. Now I'm going to talk about the third important thing you need to do, which is targeting the right sources of investment. One of the major reasons why a lot of African entrepreneurs cannot raise capital is they are knocking on the wrong doors. And there are several reasons for this. The first is some of the things I talked about, not understanding the right fit for your business, approaching investors who will not invest in you because you're asking for the wrong kind of capital, or because your business is not in the stage of business that they specialize in investing in. But another major problem is that we're limited to the options that we know. And this still comes to the whole lack of awareness problem. If all you know is a bank, when you want to raise money, you will only go to the bank. But if you realize that there are 14 other potential sources of capital, then you start to spread your attention and start to approach different options. So even though there are 15 major sources of capital, which I go into a lot of detail in my book, Jackpot, I highly recommend you get it. And I also touched on it in the free online course. These 15 sources of capital are categorized into formal, informal, and semi-formal sources. So when you're approaching a formal source of funding, like a bank, an investment fund, a private equity fund, a venture capital firm, an international development fund, all of these are formal sources of capital. They have a set criteria for people they give money, and your application has to go through a process. There's usually a screening committee, and there is a process before you get approved and you're awarded with the funds. Now, there are upsides and downsides to formal sources of capital. One formal side is that you're going to get professional expertise. So these guys don't just give you money, they also bring in their experience and expertise to support your business. One downside is that it can take time. If you're going through a formal source of capital, you need to be prepared to wait because they have to go through their processes before they approve the funding. The second the second source, the second category is informal sources. Now, these are people within your social sphere. These are friends, colleagues, friends of friends, acquaintances, relatives. You will not believe the amount of money that people raise from people in their network. And it's also not very surprising that most of the successful entrepreneurs you know today raise their seed fund. That's the amount of money you need to start the business, from people in their informal network, from friends and family. Jeff Bezos, the richest man in the world, started Amazon with $100,000 he got from his parents. And there are other people with little infusions. Mark Zuckerberg raised funds from his parents, and there are people who raise funds from a brother, an uncle, friends, cousins, friends of friends. You cannot underestimate these sources of capital because one upside is that because these people already know you and they trust you, it's easier to raise money from them. There's no process. It's largely informal. It's just based on emotion. The downside is that these are relationships you don't want to destroy. Because if you take money from these people and you don't keep your word, you're going to be destroying some very valuable relationships. And then the third category is semi-formal sources of capital. So these are sources that have a mix of formal and informal characteristics. For example, angel investors. An angel investor might be a senior colleague you've known from your days in corporate. It could be somebody in your environment, in your church, in your religious community that's been introduced to you to invest as an angel investor. So it's always important to keep these things in mind. And I touch a lot on all of these different sources of capital, 15 of them in the book Jackpot and in the free online course. And so some interesting examples, like crowdfunding, for example. Crowdfunding is an emerging strategy for raising capital, where rather than raise a lot of money from rich people or from investment funds that have the money, you can raise smaller amounts from a large group of people. So if you belong to a cultural group or your local community or something, rather than looking for one investor to give you $100,000, you can actually find 100 people who can give you $1,000. So for everybody, the risk is light, but you still get the same amount of money you're looking for. And we have 2 people inside our private community who have used this strategy to achieve significant success, raising a lot of money in the process. A lot of us underestimate the power of the crowd, how much money you can raise if you can aggregate the funding from a group of people. And of course, there are also other emerging trends. I focus on this a lot in the book. So you have, let me use one example, like Norfund. Now, Norfund is a private equity fund owned by the government of Norway. Now, normally, historically, governments do not give away funds for profit. Usually they couch it in as foreign investment or foreign aid or something. But Norway has the world's largest sovereign wealth fund, about $1 trillion at the time of recording this episode. So what Norway does is it's taking profits, it's taking returns from its earnings from oil and gas, and it's preserving that capital for its future generations. That's why it set up a sovereign wealth fund. And now part of the funds have been committed to private equity. So these are invested for profit. They are investing in financial service companies. They are investing in agricultural companies, several different things they invest in across Africa. And a lot of people just don't know. And Norfund is just one example. Almost now it's becoming a trend. Almost every country in Europe has their own investment fund, private equity fund, or international development fund that gives grants and low interest loans. But a lot of people do not understand and do not know about these opportunities. And that's why I talk a lot about them in my book. And so that's the third important thing you need to do to prepare your business for funding. So to recap, the first is to understand the basics. The second is to know your risk profile. The third is to target the right the right sources of investment. If you keep knocking on the wrong doors, you're going to get a lot of rejection. You need to target the sources of capital that are most likely to give you the funding you're looking for. The fourth thing you need to do to prepare your business for investment is to craft compelling proposals. Now, guys, there's a lot of competition for investor attention. You are not the only person who is trying to raise funding. There are hundreds, thousands, millions of people, millions of entrepreneurs like you who are competing for funding. So you don't expect to put in a half-hearted proposal or just something you scribbled on paper to get the attention. Many of these organizations get hundreds and thousands of applications every year. So for you to stand out, you need to be professional and you need to be diligent in the way you target your proposals. You need to be able to stand out from the whole pile and the whole pile of applications that they receive. And there is an art to this. There is an art to this, which is why it's not surprising that there are consultants that are paid thousands of dollars just to help craft compelling proposals, because it's a skill, and it's a skill you can learn, and it's a skill we can teach you, and it's a skill we've already taught other people like you who have used it to amazing success. Now, we're not big fans. I particularly, I'm not a big fan of getting consultants to do this work for you. And that's because when the investor wants to meet, the investor wants to meet the entrepreneur. Investors typically invest in the person. So your proposal might look exciting, but then when they invite you in person, you are disappointing. Then that means there's something off and they're not going to invest in you. Most times they want to speak to the entrepreneur. They don't just base decisions on the proposal. Even if you are in another country, they will want to Skype with you or have some kind of maybe like a WhatsApp call. They want to see you, they want to hear from you. So if you have a great proposal, because this consultant you paid a lot of money, develop the proposal for you, and then now that they are impressed with your proposal and they want to sit with you and have a chat, because that's how business is done, person to person. And then they chat with you, but they find you very disappointing because you do not even have a grasp of fundamental details of your business. You don't even understand a lot of the things you put in your own proposal. That means something is off, and of course, they're not going to invest. So, what we focus on is helping you get the capability to be your own consultant. We'll give you the skills, the resources, the training, the materials you need to develop your own proposal and defend your proposal. A lot of the problem comes in defense. Most entrepreneurs do not defend their proposals very well, and that's why it falls through. So we want you to be able to create, that way you can save yourself a lot of money and also help yourself understand your business. There is something powerful that comes when you craft your investment proposal. It helps you have a deeper understanding of your business. And when you craft it yourself, you are much more you're going to be more confident and more capable in defending the proposal. And there's a unique format that we use. It's called the who, what, how, why method. So typically every proposal, whether it's an email pitch, whether you're pitching on stage, whether it's a detailed business plan, we typically use this format. Who are you? So in terms of who are you, the investor is thinking of people risk. Is this somebody who is capable enough for this kind of business? What kind of business are you into and stuff like that? The second is what? What is the opportunity? I'm not asking you what is your product. That's a different thing, which is where a lot of entrepreneurs mix it up. Investors they want to hear about your product after you've told them about the opportunity. What is the market opportunity here? What is the problem you're trying to solve? What is the need you're trying to meet? What is the desire or want you're trying to satisfy? That is the opportunity. And they don't just want you to tell them, wow, there's a big market for this. We're going to make a lot of money. No, that's not how investors think. They want to see evaluation of the market. What's the size of this market? Who else is in the market? Is the market growing, declining, or stagnant? And what's the proof? So there's an art to these things. And if you're a member of our private community, of course, you understand what I'm talking about. You've seen this, you've seen some of our samples and templates. You've seen how gradually you build a strong story that draws the investor in. And there's the how. So you've told me who you are. You've told me what the opportunity is. So how exactly, what makes me sure you know how to exploit this opportunity? Because yes, there could be an opportunity, but maybe you don't know how to exploit it. So this is where you discuss your strategy, your competition, your competitive advantages, your business model, your operation model, and all the other ways you are going to exploit this opportunity to create value from the market opportunity. And of course, the last is why. Why should I invest in you? So in this case, the investor wants to see the potential returns on investment. If I give you X, what am I looking at? What does your performance look like over the next 2, 3, 5 years? What kind of growth are we looking at in terms of cash flows, in terms of your profits, and how would your balance sheet look like? So this is where investors want you to speak the language of money. And if you're not comfortable with finance, so one of the common handicaps I notice with people who join our private program is most people shudder. Most people don't like the sight of a financial statement. They find it confusing, but the financial statement is the most impressive thing you would love. So a financial statement these days makes me excited. And I wasn't always like this. My first life was in engineering before I made the switch to business and finance. And there is nothing more exciting than a financial statement. A financial statement tells me everything I need to know about your business, including the things you're not telling me. And that's why investors want to see a financial statement. A financial statement tells a story. And when people join the program, of course, a lot of people don't know how to make a financial statement, like from an income statement to a cash flow statement. We break everything down so that from the accounting basics, the accounting concepts, you will be able to build your own financial statements from scratch. And here's why. I've been on engagements with clients where as you're engaging with investors, the numbers are changing. Are you always going to be running to your consultants every time the numbers change? Of course, it's going to cost you more and it's more inconvenient. What if you had the power to make your own financial statements from scratch? What if you had the power to understand your numbers? There is no greater power that an entrepreneur can have than understanding numbers. Investors love entrepreneurs who know numbers. I'm not just talking about cramming the numbers into your head. I'm like understanding the numbers and telling the story of your numbers. It is a skill that you can learn. We can teach that skill. We have taught that skill, and the results are amazing. One of the exciting things I like to see is when somebody who used to be afraid of financial statements, we get on a call on Zoom or WhatsApp, and the person is relaying the numbers. It's exciting. It's a different kind of language. It's like learning a new language. That's exactly how it feels. I still remember the excitement when I finally understood financial statements. And it's possible to have that same kind of feeling. It's not something you can outsource. It's not in your best interest to outsource this thing. So the other thing you should have in mind is the format for your proposals. A proposal must not always be a detailed business plan. Most investors do not read business plans. And that's because investors are very busy people. Who has the time to read a 40, 60, 100-page document? They have time for other stuff. They have to monitor their existing investment. They need to deal with their fund providers. They also need to look at other applications. So there is a format for pitching investors. And the first is to pique their curiosity. If an investor is not curious about what you're doing, they are not going to be interested. So you pique their curiosity. You can do that with a pitch. We teach all of this inside our private program. After curiosity comes interest. When somebody like, oh, what do you do? And then you pitch it. I'm like, that sounds interesting. And then the interest comes. And what is the best way to know if an investor is interested? They ask questions. And questions are the way that investors find out about the risk in your business. When an investor is asking you questions, they are trying to measure your risk. And questions are a very, very good opportunity for you to show how capable you are. Because as they're asking you questions and you're responding, they are nodding. They're like, wow, this guy knows what he's doing. That's a sure sign of interest. And then only after interest will the investment come. I have never in my whole career of doing this, I've never seen an investor who invested without having interest. And I've never seen an investor who had interest without curiosity. So you need to pique their curiosity, generate their interest before you attract their investment. This is the sequence, and there is an art to this. And of course, inside the private program, we show you exactly how you can follow this sequence so that while everybody is trying to get the investment, jumping the steps, you go gradually and you're able to increase your chances of raising the funding you're looking for. So that's the fourth thing you have to do to prepare your business for investment. Remember, the first is to understand the basics. The second is to know your risk profile. The third is to target the right sources of investment. The fourth is to craft compelling and professional proposals. Now let's get to the final one. This final part is exactly what makes many investment deals not happen. And it's knowing how to close a deal. So you can get the confirmation started. You've piqued the investor's curiosity. They are now interested. But the conversation continues to, it gets very prolonged. The money is not coming through. Closing the deal is an art. It's a skill you need to have. If you don't get the investment and all you're getting is just interest, and you're unable to close the investment, then there is a problem. And the other mistake people make is you just submit a proposal and you don't do the extra work of closing the deal. Remember, most investors are very busy people. Even if you send that email or give that call, you need to follow up. Because without that, something else is going to replace you in their mind. So you always need to be top of mind. And another important thing you need to do to be able to close deals is to prepare for the big four most contentious issues. Now, the big four most contentious issues are the things that cause roadblocks in closing a deal. And if you do not prepare in advance for these four roadblocks, it's unlikely that an interested investor will have enough confidence to close the investment deal. The first contentious issue is business valuation. You want $100,000 at you want $100,000 equity. For how much equity in your business? Am I getting 10% of your business, 20%, 30%, or 60%? Business valuation is one of the most contentious areas between investors and entrepreneurs. Investors want a lower valuation. Investors want a lower valuation. Entrepreneurs want a higher valuation, and these are competing interests. If I can give the investor a higher valuation for my business, the investor gets a lower percentage, which means I maintain ownership and control in the company. But if my valuation is low, the investor has the advantage because he can get more equity in my business. You need to understand how business valuation works. And inside the private program, we teach the 11 most common methods for valuing a business. So business valuation is part science and part art. But you need to understand all the methods so that you know where the investor is coming from. You know the investor wants to bring down your valuation. But for you to justify a higher valuation, you need to understand the methods so that you can make a strong argument that helps you get away with a better valuation for your business. But if you are ignorant of business valuation, that means you have to defer with the person who knows what he or she is talking about. That means you have to agree to the investor's valuation. And sometimes it may not favor you. But if you know your onions, because you know the methods of business valuation, you're going to get away with a better valuation. And this is why we invested a lot of time and effort in creating the lessons that teach you the 11 most common forms of business valuation so that you can hold your ground and stand your own in these conversations. The second big contentious issue is legal clauses. So it's enough for you to send the term sheet or the investment agreement to your lawyer. But there are two important aspects you need to understand. Legal clauses have economic implications and legal implications. Your lawyer will see the legal implications, a lot of the legal implications. But it takes the entrepreneur to understand the economic implications. So when you are sending a contract to your lawyer, because you are depending on him to protect your interest, he's going to protect your legal interest. But there are economic interests that also need to be protected. And because you're the guy who is business savvy, we need your eye for that. So entrepreneurs cannot afford to be legally ignorant. You cannot just say, oh no, I don't like reading contracts or agreements. Let me send it to my lawyer. Your lawyer is going to protect you, but on the legal side. You need you to protect you on the economic side. And that's why inside the private program, we go into the 10 most common clauses that investors usually bring in to protect their own economic interests and legal interests, and how you can find them, understand them, and make a counter proposal or counter argument to defend yourself. Remember, it's your business. It's your idea. You cannot depend on a consultant or a lawyer or any other person to do everything for you. You are the decision maker. The buck stops at your desk. So you need to step into that role and understand things for yourself. I'm not asking you to become a lawyer. You can't do that. But you need to have a basic appreciation of the implications of legal clauses and understand what they are saying. So that's why we're focusing on the 10 most important ones. So you know what to focus on and how to protect yourself. The third most contentious issue is negotiation strategy. So in the end, closing the deal is all about negotiation between you and the investor. And what we're looking for is a win-win. You want to make sure that the investor is adequately rewarded for the risk they are taking in your business. And you also need to make sure that you don't end up becoming a slave or employee in your own business. So it's all about negotiation, and you need to understand where the other party is coming from. You need to understand the strategies to put forward. You need to understand your own power as the entrepreneur and your own weaknesses. And you also need to understand the weaknesses and power of the investor and see how you can craft a win-win outcome for the two people. And again, this is a skill. It's not just something you leave to chance. You may lose your business or idea just because of ignorance or ineptitude. So these things, you need to invest in advance to understand them. You don't have your meeting with the investor tomorrow and you're trying to master negotiation strategy today. That's not how it works. You need to work in advance so that you are confident stepping into a meeting. And the best part about negotiation strategy, and you need to pay close attention to this, the best part about negotiation strategy is it helps you know when to walk away from a bad deal. We don't want a win-lose deal where the investor wins and you lose. No, we want a win-win. We want the investor to be happy and we want to be happy. But if that's not happening, you need to know when to walk away, because there is nothing you're going to regret in your life worse than taking a bad deal that makes you dissatisfied and angry with yourself for losing a business that you're so passionate about. And then the fourth most contentious issue is due diligence. After all the meetings, after all the proposals and everything, most investors will not just write you a check. They won't just cut you a check. They are going to want to see things for themselves, and that's called due diligence. They might want to see your books. They might want to see your bank statements. They are going to ask you for a lot of things, because the way it works in investment is trust but verify. Now, I trust what you're saying. The investor trusts what you're saying, but they need to verify. And this is very common if you're raising money from formal sources. A bank is not going to give you money until they do their due diligence. An investment fund, a private equity fund or venture capital fund will not give you a dime until they do their due diligence. We live in a very rough world. There are a lot of scams out there. People who pose as entrepreneurs, raise money, and then just dissolve into thin air. So due diligence is going to happen. And there are things you need to be ready for. There are 4 major aspects of due diligence. And inside the private program, we go into each and every one of this so that you make sure your house is in order, so that you do not kill a deal that was supposed to happen just because you were grossly unprepared. And then, very importantly, after you raise money, it still doesn't end there. An investor can make your life difficult because they now have power in your business. Somebody who owns equity in your business or has given you a loan, of course, depending on the terms, the person is an important stakeholder in your business. They now have power in your business and they have interest in your business. If you do not know how to manage that stakeholder, they can end up being a bone in your neck. So you need to understand the difference between an active investor and a passive investor. Some investors want to be active. They want to know about important decisions you are taking in the business. They want to know about your strategy and very important things. Some other investors are passive. They don't want to be involved in your day-to-day. They are okay with getting a quarterly report or getting a report at the end of the month. So it's very important that you understand this. There's also the thing about information, power, and politics. You need to be able to meet the information needs of your stakeholders. You need to be able to play the power play between you and the investor so that you don't become an employee of the investor. So you need to understand the strength you have as your entrepreneur and that the investor depends on you to succeed. And then, of course, there's the politics. So the Roadmap program is our signature program for entrepreneurs who are trying to raise capital to start, run, or grow their business. We've had several interesting success stories from the program. We've had people who were financially ignorant, did not even understand the financial statements, have never talked to investors before, are very technical people. We've had engineers, farmers, people who have done other things in their life, but they've never understood business or how to speak the language of business. After the Roadmap program, you would not believe the transformation that happens. And even after that, I'll still be on hand to provide background support, but you have to be in the driver's seat because it is you the investors want to see. It is you they want to talk to. It is you they want to invest in, not your consultant, not your lawyer. It's you who's in the hot seat. So you need to take charge. So if you enjoy this podcast, don't forget, if you enjoy this episode of the podcast, don't forget to share it with your friends, your colleagues, your family, and anybody you know who's trying to raise capital, to start their business, to grow the business, or turn around the business. This is a podcast built for people, for African entrepreneurs who want to learn and grow. And together, we can help you achieve that dream. Cheers. I hope you enjoyed this episode of the Small Starter Business Podcast. To take our free business courses or join one of our signature programs for special entrepreneurs like you, head over to smallstarter.com to join our private community. See you inside.